Good morning and welcome back to Lexi Crypto with a K. I'm your host, Seth Thompson, for today's short session, Currency for the Future. Before we get started, I'd like to thank our sponsor, The General. Despite their commercials, they are actually a quality insurance company that has been saving people money for nearly 60 years. On February 21st, Bitcoin, one of the most highly recognized cryptocurrencies, hit a spike of nearly $57,489.10 per coin, causing major chaos and many people within minutes becoming millionaires. One of the reasons for this spike? Elon Musk, the founder of SpaceX and Tesla. On February 8th, Musk got $1.5 billion of Bitcoin as his company Tesla released a new SEC statement saying, quote, "to provide us with more flexibility to further diversify and maximize returns on our cash," end quote. With a statement like this, Tesla gives us a clear example of the future of cryptocurrency. Tesla is now the first automotive company to accept Bitcoin as a payment option. However, this raises questions that must be addressed. For those that don't know, crypto, as the cool kids say it, is held in our wallets. You may be thinking, well, how do we hold a digital currency in our wallets? That's crazy. Well, I'm glad you asked. However, these wallets are also actually online. At the present moment, to transfer money through crypto means you have to exchange a 64-digit wallet number. This can get tedious if you do it often enough. In a recently published PDF document from Core Open Research, they explain the importance of having a bank take and keep control of crypto. Quote, "However, financial institutions play an important role in addition to facilitating transactions and processing payments. They serve as the intermediary between borrowers and lenders," end quote. Although no bank holds the power of crypto because it is an open source payment option, the IRS still requires you to submit and pay taxes on any money you have made and taken out of your wallet. This shows that the IRS is now accepting crypto as a form of payment, making a way for anybody who has it to pay. With this being formed, it sets the way for banks to try and find ways to hold crypto and maintain a relationship with each of their customers so they can make money. But one major concern being displayed is the volatile market. At any moment, a currency could be priced at $4.23 a coin and drop to 50 cents a coin. This would make banking a hard concept to properly adjust and keep track of purchases and especially returns. Knowing that the banks have no current access could help develop new banks who have their own cryptocurrency tied directly to their bank. On July 24th, 2020, the comptrollers of currency, those who regulate banks, have set forth the ability for banks to hold custody of citizens' crypto wallets. However, what are some side effects that adopting cryptocurrency could have? First is the problem of adoption in crypto in third world countries. Some don't have reliable and immediate access to the internet, causing them to stick with different physical currencies. While this may seem a little bit of a problem, this is the first that will need to be conquered. With close to only 55% of the world population that has access to the internet, the local and state governments would have to work to bring in power for the first time. Second, we would have to establish a default currency that a single crypto coin is priced at. This may be centered around the US dollar, but the most major concern about this is inflation in countries that price their items at a rate that equals a fraction of a US dollar. The conversion of this currency to be worldwide would cause inflation of prices. To help navigate around the problems of these effects, scholars are studying hard to find the best way to properly enact a universal currency. Third, and most worrisome, is the corruption of crypto wallets. Because of the fact that crypto is held in an online wallet, this makes it susceptible to hacks, viruses, and corruption of data. Like all things hosted on the internet, it can be hacked. Hacking is where a person or entity purposely breaks into software to use it primarily for malicious purposes. Viruses are the other threat to crypto wallets. This could come in any form of siphoning money out on, say, a weekly basis, or it could drain your account instantly. Corruption of data is where specific data that is needed in order to run an application like our wallets is damaged and unfixable. These are all problems that will be conquered in due time. And if you're still with me, this brings us to our very last point, blockchain. Cryptocurrency is built off a blockchain, which is a very specific and very unique database. It differs from a typical database in the way it stores information. Blockchains store data in blocks that are then chained together, hence the name blockchain. As new data comes in, it is entered into a new block. Once the block is filled with data, it's chained onto the previous blocks, which make the data chained together in chronological order. In cryptocurrency's case, blockchain is used in a decentralized way, so that no single person or group has control. Rather, all users retain control as a group. Decentralized blockchains mean that the data entered is irreversible. In crypto sense, this means that transactions are permanently recorded and viewable to anyone. I'm afraid that brings us to the end of our session today. I'd like to thank you for tuning in to Curio Lexi Crypto, and I encourage you to look more into cryptocurrency and see if this is a new technology that you'd be willing to invest in. Thank you.